Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis, Wiley, and Alan Wallace.
Hello, and welcome to today's episode of The Point, sponsored by Basepoint Wealth. I'm your host, Landis Wiley, sitting here as always with my esteemed colleague, Alan Wallace, Chief Investment Officer.
Hello, everyone.
Thanks for joining us again. So before we dive into this, I want to put a little plug in for a webinar that we just recently put out covering the One Big Beautiful Bill Act that passed back in July. So that was a lot of fun to do. 800 pages.
Using the word fun loosely.
Yeah. So 800 pages that we digested down into, I think, something that'll be informative for most people.
Yeah, and hopefully not too tedious.
Yeah. So if you get a chance, if you're curious, there's definitely some impacts to most people out there with some of the new tax rules. So if you're curious about it or you've been reading about it, want to know how it may apply to you, be sure to check that out there on our website and on our social media. So. With that, we'll go ahead and kind of kick things off here with our opening segment called In the News. The topic today is actually something that we've discussed previously, which is private equity.
The more of these we do, the more it'll be something we've already talked about.
Right. Yeah. Seem to circle back around on
That's right. Yeah.
The private equity thing, we've talked about it in the past. It's always a topic that comes up. We get questions from clients and viewers. Should I be in private equity? I hear a lot about it, private equity, private debt. We've always sort of urged caution around it.
Sure.
This year, there's been kind of an increase in headlines around private equity. Do you want to talk about that a little bit?
Well, so the reason that we've avoided it for so long is because, first of all, it's not liquid. So, you're making a 10-year bet. And if you feel like there's any sort of possibility of a liquidity event over that entire decade, you're pretty much locked in from the beginning. So the time to buy things is when no one else wants them. And that really hasn't been the case in private equity for 30 or 40 years. It started with the big endowments, Yale and Harvard. At one point, they had like 40% of their assets in private equity. Well, now that there's some sort of funding pressures on them, they're starting to try to get out of some of those private equity positions to fund operations. And what we're finding is that there's not a lot of liquidity to get out of these private investments. A little known fact is there's actually secondary markets for these investments. So you're not buying them on an exchange, you're buying them from another person, right? Or another institution. And so you can sort of tell how the NAVs are printing by how much of a discount there is in the secondary market. And right now you're finding at minimum 10 to 20% discounts across the board. You're finding 30% plus in Europe, and you're finding 60 to 70% in energy. So that's when I start getting a little bit interested. So the problem is, in order to buy secondaries, you need a really good due diligence process. You need a lot of time, you need analysts. So we'd probably lean more towards a secondary fund. So a fund that buys secondary offerings from other individuals. The problem there is we need a pretty big margin of safety to counteract the cost structure, right? Because you're not only paying expenses at the fund itself level, but you're also paying expenses at the fund level. So, but if we could get an average of a 50 to 60% discount to a really good NAV print, then I would start thinking about setting up the infrastructure in order to start implementing those. So that still doesn't mean to add it in your 401k,
right? Because
you're probably buying primary issues there. You're buying things that people are trying to liquidate. So you need to be really tactical, buy things at big, deep discounts, and be really careful about who you pick to manage the fund and what the cost structure is.
Sure. And you mentioned that about 401ks, which I think is timely because there has been some discussion about maybe expanding availability of some of these alternative type investments inside people's retirement plans.
Yeah, and I think that's actually done. The infrastructure is not there yet. I don't know how they're going to do it. I don't know if they're going to set it up as a fund-to-fund structure or as a 1940 Act fund structure. I'd be really cautious about that because, you've got a liquidity mismatch between the underlying investments and the fund investments. So I'm kind of waiting to see what vehicle they use. Is it an evergreen fund? Is it an interval fund? Is it a fund of funds? And it'll take a while for regulatory environment to sort of catch up with, this new addition.
Right. So still one of those areas you just have to be really cautious if you're an investor.
Yeah, especially here, right? Because mistakes are permanent, or at least semi-permanent. Right. A 10-year mistake is really expensive. So, it's not the kind of thing where you just want to buy it because it's called private equity or private credit. Right. You want to make sure that you're getting a good fund, a good manager with a good portfolio.
And anytime you get into, fancy names, a lot of times it's just marketing gimmick.
Yeah, right. So I mean, the basic premise here is that the endowments are trying to, get rid of their private equity. So lo and behold, now let's put it into 401ks. I don't know that that's purposely done that way, but it just, it seems like an awful strong coincidence.
Yeah. Strange timing.
Yeah, exactly.
Yeah. Perfect. All right. With that, we'll go ahead and take a quick break for a word from our sponsors.
The serene sound of a line casting into the water and the thrill of reeling in a fish. Your retirement could be filled with peaceful mornings on the lake and the joy of the perfect catch. At Basepoint Wealth, we help you plan for a retirement that's as relaxing or adventurous as you desire. Ready to cast your line? Visit basepointwealth.com to schedule your initial consultation with one of our Basepoint Wealth advisors today, because from here, you can go anywhere. Basepoint Wealth is a registered investment advisor. Visit basepointwealth.com for important disclosures.
All right. Well, welcome back to today's episode of The Point. Again, sitting here with Alan Wallace, Chief Investment Officer. Hope you enjoyed that opening segment. So we'll go ahead and dive into today's topic. We continue to get questions that come in. The question that we got today, kind of timely, I think, it said headlines are starting to seem a lot more negative recently. Could you comment on the current market and economic outlook? And I think, some of the big headlines out there, just even within the last few days or the last couple of weeks, we've had a lot of talk about rising inflation, questions around how much of it is tied to tariffs, how much of it is maybe just inflation coming back that we haven't seen in a few years. Big headlines around jobs revisions. Right. We just had the annual revision showing 911,000 jobs being removed from prior months.
We're getting closer.
And I think if you look back over the last 3 years, the total now is something like 2 million jobs that have been revised out. And then continued focus on kind of interest rates and where they're going. 30-year got up close to 5%, highest in about 20 years, I think. So a lot of headlines really seem to be focusing on negative. So as the Chief Investment Officer, this is sort of your domain. So how do you put all this together? What do you see going on right now?
So, if you go back and look what we've been talking about for, the full duration of this podcast, the entire economy and markets sort of move in slow motion. Unfortunately, we feel like we need to make a lot of quick decisions. And, some of these things play out over decades. And, there are periods of time where nothing happens for a long time. And then there are, I think the old quote is there are decades where nothing happens, and then there are weeks where decades happen. And like I've been saying, we're entering into one of those periods. And I think it's okay to talk about the economy and the market when we're in those periods. Otherwise, we're sort of just wasting our breath 90% of the time, I think. But so I think this is instructive. But we've been sort of watching this slow motion train wreck towards a potential recession. And again, we live in a probability-based world, not a deterministic world. So you can't say we're going to have a recession or we're not going to have a recession. No one knows the answer to that. But what you can say is the probability has increased from 30% to 40% to 50%. And then eventually, you're at 100%. So, so the issue here is, we started with an inverted yield curve, and we called that out when it happened. And we laid out the steps at the time. We said, usually the yield curve inverts, then the yield curve uninverts, and the job market sours, and then you're in a recession, right? Well, at the very beginning, when we started doing the podcast, the yield curve inverted. A couple of months later, it uninverted, and now here we are, 16 months later or whatever it is, and the jobs market just soured, right? So for the first time now, there are more unemployed people than there are jobs open. Still doesn't mean there's a 100% chance of recession, but it means we are inching closer and closer. We had a negative GDP print early this year, very slightly. Last quarter was only positive because of the amount of exports minus imports, and so it'll be interesting to see September 25th, I think, or so, when the next GDP number comes out. GDP now is saying it should be around 3%. Again, that might be exports minus imports. We don't know, but as the job market continues to sour, that means we're getting closer and closer to a recession.
Right. So, aside from the headlines on each of these areas, there's obviously been a lot of focus on the Fed,
right,
and what they're going to do. They've got a meeting coming up here pretty quickly, and there's been debate: are they going to cut? Are they not going to cut? Powell's sort of,
I think that debate is over now.
Wavered back and forth.
Right.
It does seem with some of the latest jobs revisions that it's probably pretty clear what they're going to do.
Right.
What do we see that turning into or manifesting itself into as far as market reaction or just impact on the economy?
First of all, I want to, there's a lot of people saying the Fed, is losing its independence. But if you go back to the 1960s when Lyndon Johnson physically assaulted William McChesney Martin, over interest rates in the Vietnam War, I'd say we've been on the same path for a long time. So, the headlines make it seem like the Fed is losing some sort of independence, that it's always had. And I just don't think that's really been the case. I just think it's been a little, typically these sort of things happened behind closed doors. And now they happen in the open, which I think is good. That's a positive, right? But yeah, the Fed has sort of backed itself into a corner. And Trump has sort of shaken up the leadership a little bit. So I think the odds are pricing 100% chance of a rate cut this month. And then there's even some talk of a super rate cut of 50 basis points instead of 25 basis points. And the importance of that is that it's a marker. There's a lot of history of what happens in the markets after the first Fed rate cut. And whether or not that's positive depends on whether or not there's a recession. So if there is no recession, you typically see an increase in the market over the next 12 to 24 months, somewhere in the 12 to 14% range. But if you have a recession, then that's when you get your 40 or 50% declines in the market. So again, there's going to be a lot of jubilee about the rate cut, but it depends on whether we're entering a recessionary environment or whether whether it's a soft landing or a hard landing will determine whether or not it's good news for the market. So again, just because they cut rates doesn't mean that we can sound the all clear. Right. It depends on what happens in the overall economy.
Right. And obviously, there's a lot to be seen of how exactly it's going to play out. Like you said, it sort of manifests itself slowly over time. And a lot of times it seems like we don't know we're in a recession until it's already happened.
Yeah. The quarter after the recession is over is when they finally, declare it. So
Right. So from a portfolio management standpoint, as you're looking at different asset classes, whether it's, deciding how much exposure do we have to domestic equities or international equities, or how much exposure do we want into precious metals or commodities, or maybe even cash, right? Because I know you've talked a lot and written a lot about sort of the valid place that cash has in an asset allocation model. What are you looking at right now in digesting everything that we've seen happen over the last 12 to 18 months and kind of what's unfolding right now?
Well, in general, I'd say I'm being careful. And while I'm careful almost all the time, this is, extra careful. And that's not based on what I think is going to happen. It's based on what the risks are, what the consequences are if those risks are realized, and what the valuations are of the assets that we hold. Because if you see the high potential for future risk, then you don't want to be holding assets that are incredibly overvalued, right? So let's take a look at the S&P 500, just because that's what a lot of people like to talk about. PE ratio on the S&P is somewhere around 26.5. 20-year average is like 16, a little over 16. Standard deviation, which tells us, how far above or below we would expect that to be any given time, about 2.59. So that means we are 4 standard deviations away from where, what that range should be. And, that doesn't sound like much, right?
Right.
But it shouldn't be that way 99.99% of the time if you go back to your statistics class. If you're 4 standard deviations away from mean, that should only happen 0.001% of the time. Right. So that tells you that you're at an extraordinary point of valuation. Now, maybe that's logical. Maybe that's because AI is gonna take over the world, right? That could be. So, let's break down AI a little bit, right? The biggest companies in the world are shoveling money into this thing,
right? And
they're having trouble creating revenue, right? So they're going to spend $1 trillion over the next couple years,
right?
And every dollar they spend on infrastructure creates a 25-cent overhang of maintenance capex, right? So capital expenditures is money that a company takes and invests in plant, property, equipment, research and development in order to try to increase future revenue, right? You can break capex further down into maintenance capex and growth capex, right? Growth capex is good. It's money I'm investing in something that should start to generate revenue. Maintenance capex, not so good. Maintenance capex is like just the cost of paying the bills once I've set something up, right?
It's like the property taxes on your house.
Exactly, right? Yeah, so I build a $1 billion data center, and all of a sudden I've got $250 million of costs associated with that, right? So if we're going to spend $1 trillion over the next 4 or 5 years, that's going to create $250 billion in just overhang of costs. Meanwhile, most of these AI subscriptions are what, like $20 a month. So, I'm a very curious person, like a cat.
You have all of them.
I've used most of them, but I've been researching how much money I'm actually costing the company with my questioning. And they measure the computing power in what are called tokens, right? So, and 1,000 tokens is like $5 or something like this, if the data that the AI is telling me is correct. So an average answer is like 750 words is basically 1,000 tokens, right? So it's $5. I'm paying $20 a month. So last month my burn was $125. So on the $20 I paid them, they lost $105. Now I multiply that by millions and millions of people. So basically, you've got something like a 500% negative profit margin. So either the price is going to have to go up significantly, or the cost is going to have to go down significantly. Until that happens, AI can't revolutionize the world, right? They got to get the economics straightened out. And unfortunately, no one's going to pay $200 a month to ask questions about why their cat is needing them, or to cheat on their homework, and those are the uses that we're really seeing. I shared a chart with you a couple of weeks ago. Remember this? Yes. Where when summer happened, AI activity went down like 60%.
Right.
And also on weekends. Because that's when no one's doing their homework. Right. So it's like the whole AI infrastructure shut down when the kids were out of college. So, the use case for this is not highly profitable. Also, most companies that are investing in AI are having a really difficult time turning it into margin enhancement. So you got that big mismatch as well. So you've got these big tech companies that have grown to their current scale based on network effect, which is when every customer you bring on creates zero incremental cost. Well, they've just changed that business model to very light capital expenditure to very heavy capital expenditure, and from very profitable clients to very unprofitable clients. So if you think that that's a really good investment thesis, you should double down.
Right.
I don't happen to see it that way.
Right. And to your point, obviously those big tech companies that have just exploded in valuation, you could point and question the pricing of those individual stocks, but it's also had an outsized effect on market cap weighting. Right?
Exactly.
With like the S&P 500, because what is it? Something like 40% of the S&P 500 is
it's been
7 companies or
20% into the 30s, and it just depends on the day of the week.
Right.
So at the top of this entire structure, you've got NVIDIA sitting. And the argument is, well, it doesn't matter to them because everyone's spending money on capex and that's going to NVIDIA, right? But the problem is that when that capex slows down, which it will have to, based on the cost overhang, right? Like you can't continuously spend capex money that's creating this big maintenance drag, right? Eventually, you're going to have to show profits, otherwise shareholders are going to start to revolt. Well, once that slows down, then you've got NVIDIA trading at I don't even know how many times earnings these days. Right. It's $4 trillion. You can either buy NVIDIA or you can buy the entire Euro stock 30. Okay. Those are the same market cap.
Yeah. Isn't that crazy?
It is crazy. And all that relies on this AI thing continuing to play out the way people expect it to. The other issue is that they're not all going to be winners. There's going to probably be one winner.
Right.
And there's no guarantee that we even know the name of that company yet. That company may not have even been started yet.
Right.
So all that capex that's getting sort of shoveled into the fire could end up completely worthless.
Right.
And that not only drags down the cost of their own infrastructure, it drags down the cost of the winner's infrastructure, right? So these big technological innovations are rarely good for the producers. they're usually good for the consumer. And I think that's great. And I think we'll all, benefit from that. But as investors, we have to be really careful about investing in unproven technologies, going all the way back to the canals in England and the auto, industry and the airline industry. The only time that I've ever seen a new technological innovation really take off is when there's monopoly power involved, right? So you can think about like Microsoft and the operating system. And the classic example is Ma Bell and the telephone, right? That's purely patent protection that allowed them to build that kind of scale. If they were faced with competitors, they would have ended up like the auto industry and the canals.
Right. So when you kind of put all this together, you've got a dynamic happening of sort of macroeconomic data being not as rosy as it was,
right?
Sitting on top of markets that are, as you said, probably 40% overvalued their historic norm. If you look
4 standard deviations,
right?
So
massively overvalued,
right?
Like you said, 99.99% of the time they shouldn't be where they're at,
right?
The underpinning that's sort of allowing people to, I guess, feel good about continuing to invest, into that cycle is, well, AI is going to change the world, which is sort of spiraling the pricing even higher on these indices. But it all just kind of seems like it's a bit of a house of cards.
Well, again, I don't know what the outcome will be, but given everything that we've just said, does that sound like a good bet to you?
Right. Right. Yeah.
It doesn't to me. It doesn't mean it won't happen. It just means it's highly unlikely.
Right.
But highly unlikely things happen all the time. It's just, you're looking at a 60% decline in your asset value.
Right.
If it's successful, you might have a 50 or 60% increase. But we know that declines are 2.5 times more painful than increases. So also, if you're in retirement trying to generate income, you can't afford that type of drawdown. So, most of our clients need between 4 and 6%. We're getting that. When I look at our average returns, they're between 6 and 10%, depending on how much in equities we have. So we're hitting our targets without any exposure to this kind of stuff.
Right.
And, the most painful thing is that your brother-in-law got 10 and you only got 10, or you got 10 and you only got 8.
Right.
But, when there's a 60% loss and you're only down 10 or 15, then that's really where you pass them up.
Yeah. Go back and ask the brother-in-law what happened in his portfolio in February and March of this year. Right.
Right. Exactly.
and compare it.
Yeah. And, in February and March, when the market was down, we actually never turned negative. We had a couple of funds that did, but on balance, all of our returns across, the entire portfolios, most of them remain positive. There's always a couple outliers of someone that brought something here, or, they're 100% equity or something like that. But when I look at the entire portfolio, it remained positive throughout the year.
So the U.S. domestic stock market, at least when you look at the indices, is sort of become heavily dependent on this AI bubble,
right,
if you will, or AI euphoria, whatever you want to call it. It seems like you're very cautious about getting exposed or overexposed to that U.S. domestic investment.
Sure.
So are you looking at international? I know you've talked in the past about the place for alternative assets like gold and silver.
Yep.
How are you managing that? What's your view right now on sort of that asset division?
So 12 or so months ago, we started greatly increasing our international exposure, which has, most of those funds are up mid-20s over the last 12 months. So that paid off. Our gold and silver up 30+%. That's really what's driving our returns. We don't have a lot of interest rate exposure. We have no credit risk. So we're just sort of printing coupons of 4%. We're getting 4% on cash. And, I think the only fund we have that's negative year to date is real estate's down like 1%, which, that's out of 25 funds.
Right.
If you have 25 things, at least one of them
Right.
be showing a negative at any given time. We've had a little bit of mild underperformance in some of our equity mutual funds, but that's really because they're either smaller mid-cap funds or they've got some exposure to oil or healthcare or things like that really haven't done as well. And really, the majority of these returns have been driven by 5 or 7 companies, depending on what,
Right.
whose list you're looking at.
Right. So thinking about sort of the macroeconomic scenario playing out, does that make you more cautious around U.S. equities than what you've been even so far?
So, with 25% gains in our international, it's less compelling as it was 12 months ago. I'm not ready to start unwinding that yet. I'm definitely not ready to increase our domestic exposure either. If you look at our entire portfolio, and that's every asset that we manage, we're 51% equity. Over time, that should be closer to 60%. So we've got room to move up about 10%. And if things were ever incredibly undervalued, I'd take it as high as 65 or 70%. But really, that 50 to 70% range of equity is going to be hard to get outside of. So we're at the very bottom end of what I would be comfortable with for equity exposure. Alternatives are a little bit higher because gold and silver have done so well. We just haven't rebalanced out of them, so they've become a higher percentage of the portfolio. And we're still holding quite a bit of cash. So, if there is a market correction at any time over the next 12 to 24 months, we'd be looking to probably decrease our precious metals exposure and increase our equity exposure, also decreasing cash. If there's a recession, we'll probably see credit spreads widen quite a bit. We'd start to look to add credit exposure, maybe even some high yield exposure, depending on how much those spreads expand. And when I say spreads, I mean the difference between a treasury bond and a credit risky bond, right? So if you're getting 4% on a treasury, but 6% on a corporate, that's a spread of 2%. Right now, the spreads are like 1%. High yields are closer to 4%. I need that to be significantly higher to take on credit risk because there's the risk that the bond might, default.
Right.
You don't have that with treasuries. So with treasuries, really all you have is interest rate risk. So we can control that by keeping the maturity shorter. So we're short maturity, we're no credit risk. We're basically just clipping coupons around 4%, maybe a little bit higher. And like I said, most of our clients need somewhere between a 4 and a 6% return to make sure their money lasts the rest of their lives. There's really no sense to stretch much beyond that. Now, if someone says, hey, my needs are all met, I've got this extra pile of money over here that I want to be more aggressive with, that's fine. We can work with the wealth advisor can work with the client to say, okay, this is outside the retirement portfolio. So we're going to buy a private equity secondary, or we're going to go all equity, but I still wouldn't put it in the S&P 500.
Right.
I'd put it into equities that are, reasonably priced. We can still find equities that are trading at decent valuations.
Right. Which should help to sort of stabilize things out if the excess pricing on a large swath of the market does suddenly revert itself back, right?
Yeah, when the tide goes out, it really sinks all the ships. But, if you bought something that's generating a 10% yield on earnings, and that earnings yield doesn't deteriorate, it's going to come back a lot quicker than if you bought something at 100 times earnings, and that's never coming back. Right. So you bought Cisco in 1999 and you lost 80% of your money back then, and you still haven't made it back. I mean, that's permanent loss.
Right.
It's at least permanent loss of purchasing power.
If you're 60 years old and go through that, you're 85 years old, and
you still haven't made your money.
Still haven't made your money,
including dividends.
Yeah.
Right. So, and I think some of these companies are valued at that level right now. And that's dangerous. I try to never put myself in a situation where I need things to go perfectly just to do okay.
Right.
And that's where we're at right now. We're in a position where things have to perform exactly the way, AI is going to have to increase productivity, which should increase GDP. It's going to increase revenues. It's going to, increase margins. That has to happen in order for this market to continue producing good returns over a 5 or a 10-year period.
Right.
Anything can happen in 2 years. Returns have this sort of decaying level of randomness. In one day, it's 50-50 whether something's up or down, right? Over a year, it's more like 70% up, 30% down. Over a decade, it's like 90, Right. So the longer the time period, the more likely returns are to be positive. But when you're looking at a couple months, those returns are semi-random.
And you just got to be able to navigate through those short-term swings without hopefully introducing anything permanent on the negative.
Right. Yeah. The biggest danger is fear of missing out, right? Like I want those juicy 9% returns my brother-in-law has been talking about. That's the thing that can destroy you very quickly, right? Because especially once those outsized returns have already been earned, they become even less likely in the future, right? It's not like people have this mistaken notion that equity returns are like bond coupons. You clip them and you put them in your pocket. They're not. They're stochastic. They're semi-random in the short term. A very large gain can be erased immediately. When you're just clipping bond coupons, your returns can compound, but an equity system doesn't work that way.
Yeah. So obviously a lot going on, right? And as you said, you've always been kind of erring on the side of caution.
Right.
There's enough headlines out there now that I think any reasonable person probably would want to be cautious.
Right. And the way that we make big returns safely and this is something Ben Graham talks about in security analysis, is to wait for the market to be cheap. And his conclusion is most people can't do that, right? In order to miss the great crash of 1929, you had to start pulling back your equity exposure in 1926. You know how long 3 years is in investing? while you're literally watching the Great Gatsby, play out. I mean, that's really, really hard. But over time, your returns are significantly higher. It's just, you have to have the patience, right? Because as John Maynard Keynes said, the market can remain irrational far longer than you can remain solvent.
Right.
And as long as we're getting a sufficient level of returns, there's no reason to stretch like that. It's not that it'd be a mistake to say we're not trying to get high returns. We're trying to get them in a way that is highly probable to happen. And in order to do that, we have to buy at reasonable prices.
Right. So patience.
Patience. Yes.
Patience. Yeah. Well, it's been 18 or 24 months of sort of, as you said earlier, watching the train wreck unfold.
Yeah. I think now the train is actually up on, one side of the rails, but it doesn't necessarily have to tip. So, I mean, this isn't to say to sell all your stocks. It's just to say to be cautious, right? Keep.
Because at the end of the day, you're not selling out everything.
No,
right?
we're 50% equity.
Right.
We're just at the low end of our range.
Right.
But those equities are very special, right? They're trading at decent multiples of their actual earnings. So if there's some sort of recession or, if the AI thing blows up, most of those companies are still going to do okay. We've got some energy exposure, which will profit from the AI thing. What percent of our total energy do you think AI uses right now?
20.
No, it's 9%.
9.
But,
still that low.
Yeah, it is. But, it was 4% 2 years ago.
Right.
So, we're on a definite trajectory to get high. And our grid can't handle it.
Right.
And, so people say, well, why don't I buy utilities? Well, because utilities are regulated. They have a fixed return on equity, and they're going to have capex in order to build out the infrastructure. So the money is in inputs, and the money is in infrastructure. Right. So copper and steel, and, you can't just go out and buy copper.
Right.
So, you have to be real careful about how you allocate capital here.
Right. And that has been something that's been in the headlines as well recently, is talk around rising energy prices around the country, right?
Yeah.
And I know I've received questions from people. Does it mean we should buy utilities?
Right. But think about that. 10% of our current power is going to, people asking questions about their cat cheating on their homework.
Right.
So, that's terrifying. So, but that's not to say that there aren't any useful cases of it. There definitely are.
Right.
But I think that they've been oversold. I think that the results are still, not that reliable. I mean, you can't ask AI to print a paper for you. You have to edit it, right? You have to. It's actually still a lot of work to get good output from AI.
Right.
It's just you don't have to do the typing yourself. That's the big difference.
Yeah.
So it's really an advanced search engine at this point. It'll get better. It'll get much better. But is that 10 years? Is that 20 years? And then how long is it before the infrastructure is stabilized? Does the government actually take over the infrastructure, right? Do they start to centralize computing power so that it's not spread out amongst 10 or 30 different models, right? Do you start to have storefronts where you specialize in a certain kind of AI, right? And so the entire industry has a long way to go before it's in a profit-based model.
Right. And yet, as you said, a lot of the market is kind of pricing in that it's going to be a perfectly smooth trajectory to get there.
Yeah, we're definitely counting our chickens before they've hatched.
Yeah. Perfect. Well, I think great discussion.
Sure.
Kind of wide ranging, and it hopefully puts it into a little bit of context how some of this stuff ties into maybe some of the headlines people are seeing too out there. So
yeah, I like to say you have to choose whether you look like an idiot before the market goes down or after. And if you choose before, you underperform a little bit. If you choose after, you lose half your money. And to me, that's not a close comparison.
Right. Perfect. Well, I think that's kind of a good way to draw this.
All right.
Draw this one to a close. So. Again, really appreciate you taking the time to join us for today's podcast. As always, hit the subscribe button so you'll be notified right when we put the next one up. And then hop on over to our website, basepointwealth.com, if you'd like to submit in a question, and maybe it'll be something we chat about next time.
All right. Sounds like fun.
Till next time, thank you much.
Thank you.
Thank you for joining us for this episode of the Point Podcast, sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.